Hey, welcome in everybody. Today we're going to talk about the U.S. oil production lie. A lot of people in the globe are depending on U.S. oil and U.S. oil growth to satisfy growing oil demand. So we're going to talk about that. We're going to demystify a few things. We're also going to talk about some global dynamics, but really this is setting the stage for a price rise on US oil globally. Now the key question is always going to be when. So we'll get to that. So we're gonna step through a few facts first. So let me share my screen. Okay, so this is one of our charts inside of Energy Rogue. I'll tell you a little bit about Energy Rogue a little bit later, but this is crude oil production. And what you can see here is this is the zero line. So anytime we're below that level, we are actually declining, meaning there's less oil being produced. Anytime we're above, we are adding oil to our day-to-day production. So many people don't really recognize when the U.S. crude grows from 13.6 million barrels to 13.8, which is where we are right now, that 200,000 barrels a day. It didn't take 200,000 barrels a day of new production to get there. It took over 800,000 barrels a day of new production. So every month, there is a drop in the reservoir pressure in the US shale. And that drop in pressure means that there's less oil going to the surface without any mechanical devices or stimulation methods. That is called a decline. So every month, let me actually show you because it's probably a little bit better. Let me scroll down. Okay, so this is crude oil decline. So every month we're declining, say, 650,000 barrels a day. So every month, and these are the particular basins that it's declining from. And what you can notice here is that there's a lot of decline in the Permian. So over 650,000 barrels a day of declining production, meaning the previous month versus this month, if we're at 13.8 million barrels a day, 650,000 barrels disappear from that. So we're at 13.15. So remember that number. Now, you can flip over to the new production. These are new wells that are being added. This is why oil analysts are tracking rigs, because that's a leading indicator. Are we growing or declining? So you can see that that number is just a little higher than 650,000 barrels a day. So what that means is, in today's environment, let me zoom in on this. We grew in September by 10,000 barrels a day. So we added 10,000 barrels a day in September. So for 1 month, we added 10,000 barrels a day, but that took 660,000 barrels a day of new production to actually get that. And what you'll notice is kind of a macro trend from 2021. This number, we are still growing, but it is declining. How much we're growing is decelerating, it's dropping. So there's not really much oil growth. And when you look at crude prices, you can actually get to that same equation. So the first thing is the US production is kind of treading water. We're not really growing, we're not really declining. If we add 200,000 barrels a day versus last year, and that was an aggregate of 10,000 barrels here, 20,000 barrels here, so on and so forth. So that is the US. Now let's look at OPEC. So OPEC back in 2018, 2019 was producing about 37.5 million barrels a day of production. What you can notice is, obviously during 2020, there was a big drop in that production, and that had to do with the global supply shock and demand shock that we had at the same time. But what you can see is that we've slowly added back in, and we're at 36.5. So about 1 million barrels a day off of the top pace that was in 2018, 2019. So that means that we don't really have a whole lot of extra supply, with the exception of UAE and Saudi Arabia. They have some new reserves that they're exploring, mostly the UAE. So if you look globally now, then you're going to look at different countries and what those are producing and so on and so forth. But the picture that I'm painting is OPEC doesn't have a whole lot of supply capacity left out of their existing productive capacity. The US needs higher prices to add more supply to the mix. So those two are facts, and every other country is probably going to fall into, well, what is the oil price? And that'll tell you whether they're going to grow supply or drop in supply. So those, I wanted to start with those two things. So here's the presentation. So everyone's watching the wrong screen. We're watching the OPEC meetings, the sanctions, the tariffs, the daily headlines. This is a lot of noise, but the real trigger, oil shocks, are going to happen when that inertia meets fragility. So our productive capacity has slowed down. So the illusion is the US can always respond to these market needs. The reality, the US supply is not accelerating, it's not flexible, and it's not ready to save the market unless we see dramatically different prices. So this is the quiet, what we call the quiet collapse of US supply. Production hasn't fallen, it's doing something far more dangerous. It's flattening while costs rise and flexibility disappears. So one thing about producers is they produce their best economic return first, and then every well after that, it performs at a lower investment return. So that means that the best wells are drilled today, there's a lesser return tomorrow. And combine that with capital discipline, some geologic constraints. There's conversation on whether or not the Permian is moving into tier 2, which means less oil productive capacity, and productivity slowdown. It is still getting a little bit more productive, but at the expense of longer laterals and more proppant. Both of those are increased costs. So you're getting more productive capacity, but you're having to spend more to do it. So the US has a treadmill effect, and it's like speeding up while you're getting tired. It is actually escalating on that decline curve. So we at 80 to 90, it does respond. At 55 to 65, where we are right now, it stalls. That's just the fact of the matter, and that's just basic economics. So the dangerous assumption, markets are pricing optional supply that doesn't exist. So the assumption is the US is the swing producer, but the reality, the US is becoming a price sensitive stabilizer, not a shock absorber. We can't respond super quick. So there's going to be about a 6-month or 12-month lag between when and if, um, we need more crude supply. Now, today, there's a lot of softness on the demand side, so we don't need it today. However, if that demand starts ticking up, that means that we're going to need a much higher price to attract expansion of US supply. So this is OPEC's perfect setup. So the strategic compression, let prices sag, allow the bearish sentiment, watch the US response, which is slowing down significantly, monitor non-OPEC supply, wait for compression. This is time plus inaction, and then the price will snap violently. So what OPEC learned is the US is not coming to the rescue at low prices. They can simply wait it out. So this is the signal that everyone's ignoring. There's a red light, green light network, and there's no shock yet. Oil prices rise, production fails to accelerate, rig counts flatten, and then the green light is a rapid expansion in price. So that is what we actually look at every single day. And if you want to stay ahead of the move, I'm going to show you a few things inside. We're going to talk a little bit about OPEC, and we're going to talk about global supply and demand. But I'm showing you things that are inside of our platform, which is Rogue Edge, and we have a lower price subscription at Rogue Radar, which is $89 a month. And let me show you that. Just go to the link below and you can sign up for a 14-day free trial. You get a video, 2 weekly reports, including Rogue Radar, where we use a red light, green light system for natural gas and crude oil, along with narrative on the marketplace. But inside of crude oil radar and natural gas radar, we issue our thoughts, AI summary on what's happening in the marketplace with technicals, with fundamentals. You can actually identify, okay, the current was 13.8 million barrels a day. 3-year average was 12.9. Okay, we are rising, but last year we were at 13.5. So we haven't grown that much. We've grown a little, but we are slowing down in a big, big, big kind of way. So here's a little bit about the oil demand comparison. So there's China down here. There's India down here, the Americas, that includes North America, South America, Europe, and the Middle East. So these are the in aggregate what you watch when you're looking at the oil demand. But look at the regional oil demand. Americas represent a significant portion, and so does China. So you can see the Americas right here and China. So this is inside of our Rogue Radar, which is $89 a month. So when you're talking about oil demand, you're not talking about demand for oil. You're talking about an amalgamation of diesel, gasoline, natural gas liquids slash LPGs, other products, naphtha, jet, fuel oil. So this is in China's profile. This is India's profile, which is interesting because, pardon me, China has pretty much equal demand on gasoline and diesel. But take a look at India. India has diesel right here, but gasoline is all the way down here. So India has a lot of diesel demand. Now the United States has a very big gasoline demand because there's lots of cars in the United States. So that is what we're looking at. Is we are looking at, here's the production of the OPEC countries, and you can see Saudi Arabia is a big one. UAE is another one to watch because they have a lot of productive capacity and can increase significantly. But here's the fact of the matter. We're going to end where we started, which is the U.S. production is slowing down, productivity is stalling, and we are slowly grinding to a halt on production growth. And with that capital discipline, it is going to wait for prices to respond before we see any more. And if you want to stay ahead of the game, if you want to stay ahead of it, I think this says it best. Price volatility doesn't announce itself. It loads quietly and then it moves violently. So you need to be ready. And if you or your business follow or is dependent on the price of oil, price of natural gas, price of diesel, price of distillates, price of propane, then you should equip yourself with some information. Our product at $89 a month is a very good way to stay on top of it because you get a newsletter type format where you can digest the market from our oil analysts inside our team, as well as objective information that is presented in such a way to where you can arrive to conclusions very quickly and easily. So listen, my name is Brian. I'm with Energy Rogue, and there is a link down below if you want to learn a little bit more about us. But as we look ahead, there is demand softness right now. But once that turns to growth, we are going to have a very big shift on oil prices and the oil market because there is going to need to be price as a leading indicator of production or supply expansion. So listen, that's all I got for you today. I hope you're doing fantastic. And listen, my name is Brian. You can reach out to me down below. We'll talk soon.